So welcome to our second webinar in this three-part series. I'm Mary Conkle, University of Connecticut, and Joe Benelli is my partner at the University of Connecticut, who is also a part of this. This program is funded by the Econ Farm Risk Management Program in cooperation with the USDA Risk Management Agency, and their funding ours to have the Carrot Project in here to do this program. So a couple of housekeeping issues, again with Zoom. Although I'm not an IT person, I understand that if we get rid of the cameras, everyone turn the camera off, everything runs smoother. Please remain muted throughout unless our speakers ask you to unmute, and you can put all questions in the chat box. You will be receiving an emailed evaluation at the end of the three-part series. It'll be very small. We do ask you to respond to this. We need to respond to USDA Risk Management Agency to let them know that people actually learned something from these. And then sometime later this winter, late winter, early spring, Joe and I will be sending out another email with a very short survey on it again to see if you actually put some of what you learned into action. So again, we ask that you just take a few moments to respond to those as we go along. So I'm now going to turn this over to Jeff and Kian.
So I'm Kian. I'm Kian Delzell. I am a farmer as well as working with the Carrot Project. So this is what I do during the winter. And during the season, I'm a vegetable grower with a CSA in Western Mass. I'm also a nerd. I really like to learn things, and that is what led me to consulting. So I ended up doing this because I got a grant through the Department of Agricultural Resources of Massachusetts, and I had someone help me with my financials, and then she invited me to take a training that Julia Shanks was the presenter of, and somehow that happened, I think 6 years ago, and somehow now I'm the one giving these trainings. So you never know what's going to happen, but it's worked out okay for me, and I hope that I can help you all learn a little bit of what I've picked up over the past 6 years since I've started really paying attention to the numbers for my business. Over the course of the next hour and a half or so, we're gonna have a lot of information kind of flying at you folks. And so if you have questions, the easiest way to get them in is through the chat box. If you feel like you need to voice it, then feel free to unmute yourself. I can't really see hands because there are so many folks. So typing the chat window makes that easier. Also, if you have a question you wanna ask, but you don't necessarily wanna say it, or you don't have the audio capacity, feel free to send it specifically to Jeff if you don't want to send it to everyone, and Jeff can be your microphone. There are going to be a few moments where I ask people to talk. As always with these kinds of groups, we ask everybody to be respectful. Assume that if somebody says something a little funny, that they're not trying to offend anyone, even if they did step on your toes. And if you feel like you're the only one asking questions, going to ask you to take a breather before asking another one. If you feel like you haven't asked any questions, but you kind of maybe want to, I want to encourage you to be bold and ask those questions. And if you need a little help with that, that's what Jeff is for. So I want to make a point of saying that there are numbers in this presentation. They are fictitious. They're for illustrative purposes only. We made them up. All of the farm numbers that you need for your own business are not going to be found in this presentation. Please do not use the ones from this presentation. It'll mess up your math. What I want to do today is talk about the foundational skills that you need for scenario planning and sensitivity analysis, and then going through those processes specifically with a case study that we're going to talk about. Is there any question that you specifically want to have answered this week? Especially thinking about that scenario planning is basically the process by which you want to make decisions, especially big financial decisions for your farm. Feel free to put them in the chat box, or you can unmute yourself to ask a question. Starting to worry that nobody's using the chat box. Did I freeze and you all have just completely disappeared from me? All right, Jeff, type something in the chat box so I know it's working. There we go. Now it's working. Everybody's kind of laggy, but still here and wants to learn. Excellent. So this is the process for the folks who signed up for the whole series. Last week we did bookkeeping. This week we're doing scenario planning and sensitivity analyses. Next week we're going to talk about cash flow budgeting and break-even analysis. And then after that, it's on y'all to put it into practice. And you're going to have that with help if you want the help. And you can talk to Jeff about that because he can send somebody to help you. So right now, before this whole process started, before you started this workshop series, how do you decide when and how to make a big purchase for your business? The last time somebody bought a tractor or just did a big project, how did you make that decision? You can unmute yourselves for this or type in the chat box. Current need. Okay, what does current need look like in terms of the information you need to make the decision? I like the idea of need though, as opposed to want. I always want more implements for my tractor. The real question is, do I need them? And is this the right time to buy them? Okay, when it became painful to work without it. That's one. That's a good, when your knees tell you that you really just need a better scuffle hoe, a better tool to be able to do things more efficiently. I like that Kate is thinking about the return on investment. How long will it take to make that money back? Today, we're going to talk a lot about how long it's going to take and how to figure out, really, increasing production. That's a good reason. How to make those decisions through scenario planning. Scenario planning is a way to evaluate investments, and that includes things like changes to your business structure, adding new enterprises to some degree, but especially for things like making big decisions, changing that will functionally change the finances. And it's not just, does this increase production or revenue, but does it increase the revenue enough to cover the increased costs? Because you know that there will be increased costs when there are increased machinery or increased infrastructure on your farm. Does the increased profit cover the debt service? Are you going to be able to pay that loan back that you're going to have for the next few years because you spent a whole bunch of money on capital improvements? And does the increased cash flow, and is it worth the effort of the investment? And I think about that in two ways. How does it look the first year, and how does it look in the long term? Because I think most of us who have made big investments on our farms realize that that first year, you don't necessarily see the payback, right? Even if for something as simple as a greenhouse, you're putting in the greenhouse, so you're paying for the greenhouse and then having it delivered and then doing the site work and then getting the greenhouse up and then prepping the beds and then growing the food, and then you can sell the food. And there's this giant lag between when you put the greenhouse in and when you see the revenue increases that come from having the greenhouse. So that first year is not always the best year. And then how that cash flow works in the longer term. So in the short term and then the longer term, because after you get past that first year, it tends to be a little bit easier of a road. You see that revenue all the way through the year, that revenue increase all the way through the year. So the way that I think about that, I'm a little embarrassed to have this recorded for all of posterity with Yukon, but the way I think about it is, how much is it going to suck the first year? Because sometimes it does, and we have to recognize as business owners that sometimes that investment does suck for the first year or so. And then what happens if things go wrong or awry? Does the investment still make sense if things don't go exactly how I planned? Because we all know that everything goes exactly how you plan it, as you would be able to tell looking at my records for my seeding and my financial projections for the past decade. It never quite goes to plan, right? It goes to plan until roughly April, and then who knows what's going to happen. So scenario planning is a process by which we're laying out scenarios to explore opportunities and risks as your enterprise or your business changes. It allows us to look at the what ifs for opportunities and risks. So what happens in an ideal scenario, what happens in a standard, what we expect scenario, and then we can play with that a little bit. Things are going well, things are not going well, what those different conditions could look like. So we can look at what is probable, what the consequences are from our decisions, and then how to respond to or ideally benefit from a new situation. So we've had the past couple of years a lot of, I'm going to go with tumult. It's been a pretty changing experience to be a business owner in the past few years. And it's, I think in a lot of ways, been a question of how comfortable and quickly we can respond to our changing environment. Because we know there are, or at least there feel like there are more variables now than there did 3 years ago. Making sure that we can respond as quickly as possible. And to be able to do that, the best way to do that really is to have the data set up ahead of time, I think. So we can understand where we're the most profitable, what parts of our businesses we really want to focus on. I know someone who used to grow a lot, an enormous amount of kale and tomatoes. Tomatoes are fun. They have a higher purchase price. So you would think that they might be providing more profit. But even though the tomatoes were providing more revenue for her business, she was making more money at the top of her profit and loss statement from the tomatoes than from the kale. When she put in the costs of what it cost to actually produce the kale and tomatoes, the kale made more money than the tomatoes did. At that point, she understood that it didn't make sense to invest in increasing the amount of land she was using for tomatoes. Between the two main crops that that farm had, the kale probably made more sense to focus on than the tomatoes did. As unfun as that sounds in terms of like going to the farmer's market, that was the best financial decision. The biggest thing for me, we do scenario planning on my farm because it reduces stress and uncertainty. There's a lot of stress and uncertainty in the world, and I just want to be able to sleep at night as much as my toddler will let me. The less stress, the less uncertainty, the more sleep. Works out well for everyone. And just having a tool, sometimes you need the right tool to help you do something for your business. And for the most part, we think about that in terms of the tools we have in the field, but realistically, we need tools when we're sitting at the desk too. How do we decide, can I afford this equipment and when? So not just, can I afford it in general, but I can't afford it now. Can I afford it in the fall? Is this something I can plan for as a capital investment for next year? Or when do I need to have this equipment? Do I need it in the spring to bed prep? Do I need it in the fall because it's a roots washer? And so can I delay the purchase to when I have more cash in the bank? Can I afford to expand? How do I want to expand my business? When and how? What makes sense for that? Not just what I want to do, but what makes sense financially to be able to make my business more profitable. And then all of those things help us even out the ebbs and flows of cash over the course of the year. For many of our different kinds of farms, we may have periods of time where we have sufficient or not so sufficient cash or buffer of cash maybe in our bank accounts, and trying to even that out to some degree so that we know what is going to feel comfortable for our business and what level of risk or what level of buffer we need. And that helps us do things like figure out, which we'll talk about in a lot of detail next week, when you need to talk to the bank to make sure that you have enough cash to do what your business needs. So there's a process. We have a roadmap. Step 1, review historical financials. Step 2, identify changes, which is revenue increases or revenue changes. It's not always an increase. It usually is when we're talking about businesses, but there are moments when it's not. Today, we're going to pretend it's always an increase. So we're going to use it as we're going to use the word increase. Fixed versus variable costs, which we talked about last week, and we'll talk about this week. And I promise you, we will talk about again next week, because it is that foundational to making sure you know what your costs are for your business. Incremental expenses versus sunk costs, which is something we'll talk about specifically related to a big investment or a new enterprise. And then outlining changes, step 3, based on your new scenario. Organizing your numbers, making sure you have everything lined up so that you can see everything you need to be able to make the decision and say, does this make sense in a general scenario? And then step 6 is the sensitivity analysis. That's the what happens if, when we play with the levers to say things are going well, things are not going well. It's the if then setup where we can look at that in a lot of detail. Step 1, review historical financials. This is running a report. If you have Excel as your main form of doing your books, you may or may not have the capacity to have a report set up for you like this. But if you need help with that, talk to Jeff and we can help you get set up with whatever the next step is for your business to get you to that point, to have that report information in a readable fashion. For those of us who have QuickBooks or probably Xero, it's going to be labeled as a profit and loss statement or potentially an income statement. That's telling us what we did in the past, which doesn't necessarily tell us what we're going to do in the future. This is what's on all of the investment portfolios that none of us ever read. Performance data quoted represents past performance. Past performance does not guarantee future results. So it's not specifically what we're going to see next year, but it's the only information we really have to work off of. So it's a really important first step. And we're going to look at that and we're going to make sure that we have our fixed costs and variable costs broken out into separate sections because we need them to be in separate sections to be able to tool with them over the course of this process. Fixed costs, periodic charges that don't vary with business volume, variable costs, expenses that vary with production output. So as a vegetable grower, insurance, accountants, and bank fees definitely going to stay about the same for me. Seeds and seedlings, animal feed, which I don't have to worry about, labor and payroll. If I increase my production, I expect to have those increase. And the way that I think about it personally to make sure that I have the right category to put things in is to say, okay, if I were to sell, not just produce, but produce and sell, because it's all about the revenue, twice as much next year. If I just completely doubled my production next year, magically, would this expense be roughly double? And so for me, seeds and seedlings would be roughly double. The packaging costs would be roughly double. The kind of additions that I would need for fertility or the wear and tear on my tractor, those things would roughly double. I would expect to pay about double of those things. But I wouldn't really be paying my tax preparer double. That'd be the same. I would probably have a little bit of an increase in my insurance, but not dramatic. It wouldn't double. And my bank fees would hopefully not be there as much because if I was making that much more revenue, I would hope I had made the right decisions for where to increase revenue so that I would not have any late fees. Not that I have them now most of the time, but if you're increasing your production that much, we can pretend that your bank fees will go away for the most part. How does everybody feel about that? I want to make sure everyone's real comfortable with fixed and variable before we move forward. Thumbs up, smiley faces in the chat box, please. Something that lets me know you're there. All right. So far, everybody seems to be good. I do like the shades smiley face. It's a good one. So now that we've...
Kean, we have the question, can we say variable costs are the costs of goods sold?
No. And we'll look at that in a little bit more detail in a few minutes. It's a good question. But I'm going to say very specifically no, and then we'll go into detail in a few minutes. So today our case study is Waterville Farm. This is one of those moments where we've made up the numbers, right? Waterville Farm is a diversified farm growing organic vegetables and poultry. They sell at local farmers markets as well as on-site through an honor system farm stand, which means it's not staffed. Owners Sam and Rachel want to renovate their barn to create a larger farm store area with a parking lot. They're in a high population area with good traffic counts and have decided that they need the upgrades to increase their on-farm sales. They plan to sell more of their own products, so they'll be increasing their production, as well as meat and value-added items bought from other local farms, which means that they'll have some purchased items for resale. Given the labor and time constraints of selling at farmers markets, they think on-farm sales are important to their growth, and they really want to focus there. So they're working toward an owner's draw of $50,000 per year as a long-term financial goal for them. They're going to sit down with their financial advisor. We're going to pretend that's each of us to line up their numbers and decide when and how to make the best improvements. So they have some goals in mind, not just one, right? For their business, they have a goal of an owner's draw of $50,000 per year. And they also, it looks like they have a goal of not going to 8 farmers markets a week, which I think is a reasonable goal for a lot of small farms. They want to, it looks like they want to support their local food shed if they're planning on buying in stuff from other farms to make this a building revenue option for them. So they've got a lot going on here. And thankfully, for the purposes of our case study, they have some numbers that we can look at. So the first step that we have in our scenario planning is to look at the historicals. This is last year's numbers for Waterville Farm. These are completely made up. They were made up a couple of years ago. So if you're looking at it going, this ratio doesn't seem quite right for fruit versus vegetables, just ignore that. So what we're looking at is the amount. This is going to be basically their profit and loss statement, right? The revenue, and then the different categories of revenue, the accounts in their chart of accounts for their revenue: eggs, meat, birds, fruit, flowers, vegetables. So their total sales altogether is $194,000 last year. Hopefully they have a good ongoing financial advisor to make sure that they're really working through this stuff and staying on top of it. Their annual expenses, they have that broken out into cost of production, which is the variable costs for this farm, and the overhead, which are the fixed costs for this farm. So their cost of production, their labor, supplies, packaging, which they break out specifically, repairs and maintenance, and processing expenses for the meat birds. They break that out specifically because processing expenses only apply to one of those categories. In an ideal scenario, or in your numbers, what you would probably want to see is a lot of stuff that's specific to each of those categories, but we simplified stuff to make it easier for us to see all of these numbers for these folks today. And then their overhead: mortgage, utilities, insurance, professional services, that's paying you or me as their financial advisor. And then office supplies, including their utilities for those things. One of the things that I think a lot of people forget is that your farm is supposed to pay for its utilities. So if you are, if you're using utilities for your farm should be paying for your utilities. So don't just cover all of that from your owner's draw. That's not how it's supposed to work. Because of the amount that we have in their production and labor, we're looking at, for $200,000 worth of revenue, they have $60,000 in production and selling labor. That tells me they're probably not paying themselves from that $60,000. So they're probably looking at that $50,000 draw that they have as a goal as the cash flow, or out of, not all of it, but out of the net cash flow. So right now they're not seeing that number. What they want to see is a 50,000 right down at the bottom there with the net cash flow. So we see that they've broken out their variable and fixed expenses. And specifically, we're looking at, with this, it's giving us the percentages, which is something that you can do in bookkeeping programs like QuickBooks to be able to show you what percentage of revenue your cost of production is, and looking at it by each category. And that lets you kind of toy with things. If you can make things a little more efficient, those percentages will go down as your revenue increases. So that can be a really good way to compare year to year. So we're learning a lot from these historicals, but that doesn't necessarily tell us how to parse out profitability. In a real world scenario, a diversified farm like this would have a lot more detail in their profit and loss statement, but then we wouldn't be able to look at it on one screen and it would get very confusing. Are there any specific questions that you have that you can think of that these numbers don't answer, that you think you definitely want them to? You can put that in the chat box or unmute yourself. Is there something you're looking at this and going, I don't think you'd be able to make a decision based on these numbers? All right, I'll add one.
Wait,
They
sorry. Okay.
Oh, please.
So it doesn't tell you anything about cash flow. Like, will they have the money at that 29.5, when does it come in the year? Does it come at a time when they need to pay for when they want to pay for the construction?
Yeah, so they've got, they have, this is the whole year altogether, which doesn't give the detail of cash flow at all. We know that over the course of the year, by the end of it, in theory, they have 29.5 in the bank or to pay themselves with. But it doesn't give us that detail. If these folks took this workshop series, they would learn in week 3 how to break that down from month to month. So they'd be able to see it in more detail. My biggest pet peeve about this would be that the dollar number for production supplies gives you all of the production supplies, which works for a general case study, but would be absolutely terrible for you to do for your business. We don't know how much per pound the birds are sold for and the pricing is for each category. And you wouldn't necessarily see that on the profit and loss statement, but you definitely need to know that. And Steve knows you need to know that before you can make any real decisions about how to increase your profitability. So let's figure out if we can increase their profitability with this new farm store that they want to build. We're going to do that by identifying the changes. We're going to look at revenue increases or potential revenue increases in this new scenario that they've decided they'd like to pursue. We're going to look at making sure their fixed and variable costs are in the right categories, and then at the incremental and sunk expenses versus sunk costs, which is a lot of what we're going to be talking about today. Basically, making sure you have everything in order when you put it into your spreadsheet. So the way that we're going to do that is by making some projections. There are a couple of ways to make projections. One of them is to do, I call it top-down projections, which is to look at the top number, the big number, the revenue, total revenue for your business, and start there. I can grow this business by 60%, or my revenue will increase by $120,000. It's the big number. Then you start from the big number and break it down from there. This is an expectation, not a desire. I know you want to double your production for next year and make yourself incredibly efficient as a business. That's not likely to happen. There will be steps along the way, but setting those financial goals in the what can we do next year and what are our long-term goals are important. Right now, we're talking about what we can do next year. And these are annual projections. We're going to deal with loans and grants related expenses separately. We're also going to look in more detail at a month-to-month separately. So with these upgrades to their farm store, Waterville is projected to increase 50% in revenue, or about $98,000 next year. A 50% increase in revenue is on top 50% of this year's sales again. So we go from functionally 2/3 to 3/3 of what you expect for next year. They start with the big number. Once you have this big number, we've got to break that down and look at how much of an increase can each category handle. How much do they think is going to be in the new resale category? What additional costs will the farm incur to create that kind of money? And does that increase really move the farm toward its financial goals? If they aren't going to do the upgrades, then they project that they're going to increase 5% in revenue, or about $8,000. And then they have the same questions. How much increase can each category handle? What additional costs are going to be there to incur that? Will the farm incur to generate that additional 5%? And how much, or does that really move them toward their financial goals? So we put it in a spreadsheet. For ease of use, this is in the PowerPoint presentation, but I promise you it's also in the spreadsheet. So when we're looking at this, they said, okay, we're going to be able to increase by about 50%, 51% in the upgraded store, but it's not all going to increase in the same amount. We're going to add in a resale category. So I think we're going to do 25 grand in that, based on how many customers we have and how much meat is going to cost and what else we expect to sell. Maybe some cheese. Cheese sells very well in a lot of these farm stores. So they break that out into resale products. Now they have that large number, that $98,000 minus $25,000. They have to figure out what categories can take that increase reasonably well. So they don't think that the meat birds are really going to do it. Maybe they're not seeing the same kind of interest on those. Maybe they just don't think that they're going to be able to make or tend that many more meat birds because they're kind of a pain in the butt. But they decide to focus not on the meat birds. They can see a pretty big increase in eggs as a potential. They're looking at an increase in fruit and flowers, but they're not the same percentages all the way across. They're seeing 55% increase in vegetables, maybe because vegetables, most of those are going to be annuals. So they'll be able to make those purchases and plan for that over the course of the season. Maybe it's because they expect to be able to do more hard goods like squash. Their fruit is going up a lot. Maybe they're expecting their blueberries are going to finally really produce at the level that they've been hoping the past couple of years. Maybe part of their reason for wanting to do this farm store is actually because they've been planning for this kind of increase in production and they realized, oh crap, we'd have to go to 3 more farmers markets to make that work, and we don't have that kind of patience or capacity of labor. And here you can see that we broke out the goods for resale into cost of goods. We look at these broken out kind of separately than the rest of the numbers. And the reason is that they don't correspond to your total sales in the way that your other production does. So your cost of goods sold, which is another way to say goods for resale, the stuff you buy in and then just turn around and sell and don't change it all, you're not producing it. You're bringing it in, taking it out of the box, putting it on the shelf and selling. So that number only relates to the resale products line. All of your other numbers for your expenses are going to, all your variable expenses are going to specifically relate to your total sales, your revenue. So we're going to break that out a little bit separately. If they're not going to change anything for this coming year, they expect some modest increases. Maybe they have a price increase. Maybe they expect to have a few more people coming. They have some very dedicated folks coming to their farm stand. We're going to the farmers markets that are going to really pull that that extra friend in or come a little more frequently. So they're expecting 5% overall increase, but some of the categories they only really expect to do 3% increase and not have that giant jump. Again, goods for resale is always broken out from other expenses. And if you need help being able to do that in your own numbers, talk to Jeff so that we can make sure to get things lined up for you if you're doing this so that you're not conflating your production costs with your goods for resale. The other way to do it, so we started with top down, starting with the big number and breaking it into little pieces. The other way is bottom up sales projections. And as a production-minded person, I think of things mostly this way. So it's the level of production that I can handle, that my business can handle, and then turning that into dollars. And it's the amount that you can handle in terms of production and sales, because it's really about the revenue and not about how many pounds of daikon I've grown. It's about how many pounds of daikon I've sold and how many dollars that is. If anybody asks, I do need to sell some daikon. I'm looking for a kimchi provider. In any case, we're going to start from the production. We're going to consider the land and staff restrictions. What can you really actually produce on your property? And then reaching your financial and production goals may not happen in 1 year. It doesn't matter which way you look at the numbers. We all think in a longer term way than next year is really going to produce for us. So you have to think about not just, I want to get to that $50,000 owner's draw, but I need to take steps in that direction. How am I going to take steps in that direction? What's the best next step for me to take in the coming year? So with upgrades, how much more can be produced and sold by Waterville in each category? How much is going to be in that new resale category? How does that add up? And then what additional costs will the farm incur to generate those sales? So these are the same questions, right? Does that increase move the farm toward its financial goals? It doesn't matter whether you start from the top number from revenue and break down or start from the little numbers. how much I can produce in each category and sell in each category and build them together and add them all together, you're going to be asking yourself the same questions. How much can I sell? Or how much can I produce and sell? And what does that turn into in terms of revenue? How does it interact with my restrictions, like land, like labor, like access to markets, and making sure that all of those questions are asked as part of your projections is important regardless of which direction you go. Whether you're doing, and you do the same set of questions over and over again. So you're doing with upgrades and then without upgrades, if you're looking at a big project like Waterville's. For me, I like to have a list of questions, a physical, actual, well, digital, actual list of questions. So then when I'm doing the scenario planning, I can really go through the same list of questions in the same order. And then I change the scenario, ask the questions again, see how it changes. This is the words version of what we're going to do in the numbers over the course of today's session. It's repetitive, but it's really helpful when you're working toward mastery and comfort and confidence in making these decisions. And it's also really, really helpful if you have more than one decision maker, because then you can have the same set of questions and you can also have different people looking at things in different ways. I worked at one point for a company where the general manager made top-down sales projections and each of the department managers made bottom-up sales projections. So then you can sit down, in this instance, it might be you and a business partner, sit down and compare the two numbers. If your numbers are pretty close, that's great. You have a very similar sense of where you want your business to go and what that's going to look like. If the numbers are not close, it gives you a lot of opportunities. And with the set of questions, it gives you a structure to guide the discussions as to where the goals are different and where the expectations are different among the decision makers and for your farm. So for Waterville, if we were going to do bottom-up sales projections, you start with one category and you do it for each category. So if they have 700 laying hens, how many eggs does each hen lay on average per year, which they would have in their records, we hope. That leads us to 140,000 eggs, which translates to 11,666 dozen. At $6 per dozen, $70,000. You can tell by the rounded numbers that we made this up. Please do not use these numbers when you're doing your own sales projections. It will mess everything up. I'm going to say again, though, this is the eggs that they sold, not the eggs that they produced necessarily, but the eggs that they sold. So each of those hens may have laid more than 200 eggs, would necessarily on average have laid more than 200 eggs in the year to be able to account for the losses that the cracked eggs, also the ones the staff eat because they don't pay for it, until you get to the point of the number that you sold or the number that you plan on selling. So you have to build that buffer in when you're asking these questions. You do the same thing for the next category. 1,000 meat birds. This is where Steve, I think, had this question. 4 pounds each, 4,000 pounds, $5 a pound, $20,000. 1 acre of flowers. Last year you did a half an acre and got 20 grand out of it. You know you can double it, so it's $40,000 per acre that you're projecting. 7 acres of vegetables, 20,000 per acre. Altogether it'll be $140,000. So then you add those together and your projected revenue for the farm store would be $270,000. This might not match all of the projections for your business, because if you're also selling at the farmer's market, you may be looking at those projections in 2 pieces, or it might be everything for the whole business. As long as you make sure you cover all your bases for your final numbers, that works too. So again, there are functionally 3 questions that you're asking for the purposes of getting the numbers lined up for your projections. When you're looking at last year and as you're projecting to next year, the data you need is how many layers did you have? How many eggs did they produce? How many eggs were salable and how many actually sold? So you're talking about production. You're talking about what's salable, so the loss at that level, and then what's sold, which are sometimes 3 very different numbers. So it's important to have as much data as you need from your records to be able to feel comfortable and confident as you move forward. This is one of those moments, though, that fuzzy numbers are better than no numbers. So whatever records you have are better than not having records at all about it. And the more records you have, whether that's more than 1 year or being able to really focus in on a couple of weeks over the course of the year, the better data you'll have when you go to do these projections, which you'll probably do about once a year. There's another way to do bottom-up sales projections. As someone with a psych degree, this is a way that really makes sense to me. The person-based version, the average customer statistics. So if you're looking at your farm stand from last year and you saw 2 customers per hour on average, 12 hours per day that you were open, $25 per basket on average, which is also per transaction, really. So if you have, say, Square or PayPal or Venmo, you can see that amount. If you're working with a cash box, you're probably making some guesses. That adds up to $600 per day, 180 days a year, $108,000 per year. If you don't have the level of detail or the time to watch whatever video you might have set up for your farm stand, you know that you were open 180 days last year. You know that you made $108,000 per year from your farm stand. You now have an average per day. The other things may be extrapolated. There are some days that you will make $0. There are some days that you will make twice as much as average, which is why we talk about averages, so that you can plan in general. We need to be looking at the averages. With Waterville, they're expecting that because they're going to have a bigger parking lot, they'll be able to have 4 customers on average per hour. Some hours will still probably have 0 customers, but they'll have space for 8 people to park. So during the busier times, they'll have 8 people that could all be there at the same time. So if we expect to have $30 per basket, 4 customers per hour, 12 hours a day, that lands us at $1,140 per day on average. Some will be lower, some will be higher. Overall, we're expecting that to be about the average. And that might be based on, if you're looking at these, it would probably be based on that you expect to have more customers and you expect to have their baskets be bigger. So we know roughly what we did last year. We can extrapolate that into what we can maybe do next year. But because we're also getting this improved space, we're insulating the walls, we expect to be able to be open 210 days. We're adding a month. So then that puts us at just shy of $240,000 coming in from the stand, which is a pretty big increase from what we did last year. If we don't change anything, we expect to have the same number of customers per hour, same number of hours per day. We're hoping to have a few more sales per basket. We've learned that people really love the flowers. We want to make sure that we have them there more consistently, and that's going to increase our basket size. We know that we were a little short on eggs at a few points last year. We're getting in some new pullets so that we have that available so people can purchase it. So we're hoping to elevate that basket size a little bit, not that much. So it'll increase $30 per day over last year, which over the course of 180 days will give us $113,400. So now we can see next to each other what we expect with and without the changes based on the people. So we've done it based on the revenue, big numbers to small numbers. We've done it based on the production that we think we can achieve. And then we've also done it based on the people. But this is, again, just for the farm stand or the farm stores. So the farmers markets would be calculated the same way, aiming at averages, which accounts for rainy days. So one of the things that's difficult with that, particularly with farmers markets, is a wet year, you might have a really terrible foot traffic at a farmer's market. And in a dry year, you might have a terrific foot traffic at a farmer's market. And there's really no way to know when you're making these projections what that's going to look like. So the averages, using averages, help us kind of account for that to some degree. And then marketing plans take care of, hopefully, the rest of it. So the next question is, you're looking at these increases. How do you plan on increasing your customer count? What are those things that you need to do, to plan for, to make sure that the product people want to buy is in the stand and they're putting it in the basket? And how do you plan to increase that dollar amount on an average? Is that adding more customers, or is that adding more money to each basket? Ideally, it's both. It's often easier to get people to buy more that you already have the people stopping in than it is to get more people. But we also always want to be reaching out to new people and inviting them to come and have the delicious, wonderful food that we're all spending an innumerable number of hours of our lives growing. We want to share that with everybody. And so bringing in new customers is also important. Having a marketing plan to be able to address these kinds of questions is really important. We don't do a lot of that at the Carrot Project, but we might be able to get some help for you through other organizations. So if you have really good questions about that, if you just feel a little adrift about that, email Jeff. If the Carrot Project can't help you, he will have probably some good suggestions as to other organizations that might have marketing plan support for you. Does anyone feel like this woman right here? If someone is saying none of this makes sense or you've stopped making sense, let me know. Let Jeff know, let me know, and we'll make sure that everybody gets on the same page, okay? So we've been talking about this to death, fixed versus variable costs. We're gonna do it one more time. Fixed costs, periodic changes that don't vary with business volume. Variable costs vary with business volume. So what if you produce twice as much next year? Would this number go up in a similar amount? Because the next thing we have to talk about is incremental expenses and sunk costs. It's been a while since we looked at the process. We're still in part two. Part two is the big long part. We're at the last part of part two. Now that you're really comfortable and confident with your fixed and variable expenses, we're going to make it even more confusing. We are going to add startup and ongoing, as well as incremental and sunk. We've got lots of new words for what we're doing here. So we have this plan for a big change for Waterville Farm, and then we have this plan, this no change plan for them. The difference between those things is what we're going to be talking about for the next few minutes. For this big farm store production, this construction plan, we need the startup expenses. We need to know what kind of funding we're going to have or they're going to need. We're going to need to figure out what the incremental revenue and expenses are. So what the kind of ongoing expenses are specifically associated with this. A big part of this is, can you get a loan or a grant, and where can you get a loan or a grant? Who can you ask? Getting a loan means going to the bank most of the time, but getting a grant, there are a bunch of different sources for that, right? There's the state, there's the USDA, there's NRCS. Depending on your project, there are different grant opportunities. Talking to folks at UConn or other organizations in your area to be able to keep track of those and get assistance when you need, so that you can jump on those grant applications when they're available, is really, really helpful. So as you're going to sit down to do this, if you're planning for Waterville Farm or for any large change for your business, the startup, before you really get started on anything, you're going to need everything set up for your starting up costs. What equipment needs to be purchased? How much is it going to cost to purchase, install, ship? How much is it going to cost to do the build for any physical building changes? How long is it going to take? Once you have that worked out in your head, then you need to question, do I need to borrow money? How much and for how long? Is this a really short-term loan? Is this a longer-term loan? How long is it going to take to pay back? What are the terms? How does that look like? So financing is something that you want to consider and go through all the details of before you actually pull the trigger on anything. And then day-to-day operations. What's it going to take to run the enterprise on a daily basis? What kind of incremental or new expenses will I have associated with this operation or this new aspect of my business? And will I have increased efficiencies? I certainly hope so. I'm putting a lot of effort into this. And then the revenue question. How much can I expect to earn? And when am I going to earn it? Just like with that greenhouse, there are all these phases before the revenue starts coming in. And if you're putting radishes in that greenhouse, you get a sooner revenue, although whether radishes would be worth putting a greenhouse in for, I have questions about. But the longer season the crop, the longer it is before that money starts coming back to you, before it starts paying for itself. So now that we have these, we need to make sure that the incremental costs that we're looking at, the changes we're looking at from our no change business to our changed business, is going to be broken out properly. The expenses that will change, we need to see how that's going to work for each of our fixed and variable costs that are already in our profit and loss statement, and what additional items we will be adding to it related to this project. What's going to happen in the short term, and what's going to happen in the longer term, what's going to continue to be an expense. Not all of the expenses are going to increase the same way. So we're going to be looking at current operations, which we're going to call sunk costs, and improved operations, incremental costs. Outlining the changes based on the new scenario is putting down on paper the things that you just thought about. So you spent the time thinking through what you're going to need, and then you need to break it out and put it on paper. There's a joke that every consultant has just a binder full of 2x2 blocks like this for people to fill out. And I think that in some ways it's true, because when you think about it, you have a lot of stuff flying around in your head. You're making a big decision for your business. It's got a lot of aspects to it. You need a way to simplify and really just break it down into a simple, fairly small number of categories so you can wrap your head around each of them. So this really helps with that, I think. As we put these things together, we're going to be looking at the startup inflows, which is all of the money that's coming in, not just the revenue from selling the things you produce. When you're looking at something like the Waterville Farm Store, you're going to be looking for grants or loans. You might be putting in some retained earnings. And then there's going to be the cash outflows during startup. That's the equipment purchases, the installation, the shipment, the operating expenses before revenue. Do you have staffing concerns that need to be dealt with in a startup fashion? Make sure you think through all of the things you're going to need to buy ahead of time. And then there's the ongoing stuff. That's the stuff that's not part of the first build section, but you'll be seeing for years to come with this new and improved version of your business. So the inflows are going to be your sales revenue. That's usually the ongoing cash inflow from any improvement to your farm, right? Increased sales revenue. The ongoing outflows, the daily operating expenses that you wouldn't have had if you hadn't done this improvement, the incremental expenses, the increased efficiencies. So the cash outflows what they're going to look like is going to be influenced by what you're buying or what you're spending money on, and how much you really need to spend relative to the revenue. For Waterville, they're going to get a loan. I don't know if they didn't want the grant or they didn't get the grant, but for the purposes of the Waterville Farm Store, they're getting a loan. They have solid terms with a nice bank. They like it. And they're comfortable with that being the source of funding for this project. And they're planning for increased sales for ongoing cash inflows. Their startup is going to be construction, coolers, shelves and displays, register and point of sale system, which is POS. It stands for two things. Most IT people who work with them will tell you that it stands for two things for everyone who works with a point of sale system. And then hiring or training, if you need to have someone hired and trained for day one, that's a startup expense because they're not going to be producing anything at first. When you're thinking about the things that you're going to need to purchase for your business, for this kind of improvement, particularly for something like a farm store, you really need to go through everything you're going to need over the course of the day and what you're going to be interacting with. So put yourself in the headspace of someone who's going to be going in to run the store for the day. You walk in, you have to unlock the door to get in. One of my favorite stories about a farm store is actually one of the places I apprenticed many years ago. They put up a farm store and they got sliding doors. There was no way to lock them. And so years later, they had not, instead of replacing the doors, because they had, built this little farm store with these particular doors in mind, at the end of the day, somebody had to chain and lock with a padlock the doors closed. It looked very pretty on the side of the road. But nobody had thought about it because no one was thinking through everything that goes on, because on that first day, you want to have all of your displays set up. The stuff that you're buying in from other farms for the Waterville Farm Store, the meat that you're buying in from other farms, the cheese, if you're buying in soap from one of the local producers, all of that is something that you have to purchase at the beginning. So even though they're not necessarily going to be covered, and they probably won't be covered by things like a loan, or they may be covered by the beginning of your loan, but you want to make sure that you're considering those costs when you're planning for these things. Because if you only get everything planned for the construction and you don't consider the mop bucket, the water that you're going to need, or the sink that's going to need to be out back for hand washing, if you don't consider all of those little bits, you're going to be spending more money on that you hadn't planned for. So going through all of those expenses ahead of time can be really helpful. And then the ongoing cash outflow, where the money is going from this improved business, is going to be the additional payroll, the maintenance costs, and the utilities. And then also you're going to be paying back that loan that you took out, the debt service. For Waterville, we've got some numbers to go with that. We have a bank loan for 145 grand. If you do the math on the cash outflows for startup, it's 145 grand. They planned for the loan to cover the expense, getting them to day one. The ongoing increased revenue is projected at $98,400 in the first year. And then they have projections for the ongoing cash outflows for the first year. It's important to note that the debt service is not going to be for forever, and that the ongoing increased revenue will probably increase more than it does the first year after that. So you have, 1 year's worth of view, which gives you a good starting point to get your feet under you. You can't really plan 10 years out in this kind of detail, but you need to plan the first year in this kind of detail before you buy anything. So once you're looking at all these numbers, the next question in your head is going to be, will I have more or less money in the bank at the end of the year? And next week we're going to talk about the month to month throughout the year, but realistically, when we're talking about the annual stuff for this, you're going to be looking not really for the profitability is not at the top, it's at the bottom of your profit and loss statement. It's not the amount of revenue, it's not the amount that you spend on expenses, it's the amount that's left. It's what's left after all of your expenses are paid and your debt service is handled. So profitability is found in the cash flow at the bottom. You're looking at, this is why it's called the bottom line. Is your business profitable? Is your profitability increasing? You have to look at the bottom line on your profit and loss statement. So then you have all these numbers lined up. You have to decide if this makes sense. And the only way to do that is put it in a spreadsheet, especially if you think like I do, and then look at all the numbers lined up. So then we need our spreadsheet. Does everybody see a spreadsheet? All right, Chaz sees a spreadsheet. Some other people do too. All right, we're all in Excel now. So now you have this set of numbers. You have this planned out. Your startup expenses are in a separate category. We called it capital expenses. They're in a separate category than your annual cash flow. Because you're getting a loan to cover those. We want them there. We want to see them. We want to know that they're there. We don't want to really be focusing on them. It's one of those things where like, I have $145,000 of a loan coming in. I have $145,000 I'm spending based on the loan coming in. I am now going to put those at the bottom of the sheet and temporarily ignore them. We have the projections that we talked about for our revenue. We have the cost of goods that we talked about that's specific to our resale products. We have our annual expenses. So when we're looking at these expenses in general for the business, we're looking at not just the number, the dollar amount, but also the percentage. You can see that last year their production production and selling labor was 31%. With this upgrade, we're hoping that we can bring that down to 23% overall. However, that doesn't include the new labor for the new business. So the incremental expenses, the new expenses, are going down in a separate section so that we can assess that it makes sense to do this and play with the numbers in a way that makes sense. So this is a dynamic spreadsheet, which means that I can change this and it'll change the number. That's all it means. So if we can't bring down everything, but this is where we assume it's going to go in general, that we'll get some efficiencies out of these things. We're not expecting an efficiency in packaging because we're not going to really be increasing the packaging purchases that much, but we're hoping to be able to dramatically increase our labor concerns, and we're hoping to be able to increase or decrease rather the percentage that's being required for repairs and maintenance. We're getting more efficient in our business because we're going from 69% at Waterville Farm last year in cost of production to 54% in the coming year with the new expenses broken out. And then we're looking at the overhead. That doesn't change, or at least it didn't for these folks this time. In reality, their insurance would probably have gone up a little bit, but we're pretending that it isn't going up at all. It's staying at $30,000 because overhead doesn't change much. There are a couple of reasons that we would assume the production cost percentage would go down. One of them is actually that some of the production labor is being shifted into this person here that we've hired. Because right now there's nobody staffing the farm stand, but there is someone checking on it a couple of times a day. And that person's going to be in the field more and be able to produce more. And things like production supplies, if you're buying more, there's the added benefit you get of buying in bulk. So we're assuming that with this kind of, because this is a pretty dramatic increase, and Steve says not driving to the farmers markets. The original version of this many years ago, when this case study was developed, almost everyone the first time it was used said, well, that's because nobody wants to go to farmers markets anymore. And personally, I hear that. I am not made for farmers markets, but some people really like them and they're very important and they have a really good potential for margin for some folks. So no shame on the folks who love farmers markets. It's not for everybody. Some of us did not become farmers so that we could deal with people in a like setting. In this instance, we're hoping that they can figure out what that balance is for their business in a way that makes sense. Kate, did I answer your question adequately?
I guess it just seems like 15% more efficiency in your cost of production seems like a lot. Is that kind of standard, or is that, I mean,
Not standard. The
yeah.
numbers are made up and the points don't matter. It's one of those things that we've just decided that for this purpose, we're saying that there would be an increased efficiency. They may be, because it's the dollar number goes up, right? So it's not that they have fewer people. They have maybe another person during the summer season, but they're additionally removing whoever is going to be, who has been tending the farm stand is now accounted for separately.
Okay, I guess so. How you're actually detailing out, like, okay, this is the labor, my labor. You're detailing out all of these things based on the increased production, right?
So we have the increased production here and then the increased sales capacity through the farm store separated out. But again, the numbers are made up. Please do not use them as a standard.
No, I just mean, are you guessing at it? Like, if I'm going to try to do this with my farm, I think what you're saying is I shouldn't be guessing. I should be doing a budget for when my production supplies. Yeah. Okay. I think I got it. Sorry.
Right. You're going to be looking at a budget with real numbers. And No, you absolutely should be asking these questions. If you were doing this for your own business, you would want to get everything lined up for your business. I will say without reservation that having someone sit down with you and help you get these things lined up prior to making large scale purchases and doing large scale infrastructure investments for your farm is really important. So if you're thinking about doing something like building a farm store, get someone to help you. There's funding available for somebody else to pay for someone to sit down with you, whether that's through a small business support or an ag support organization or through an extension or through NRCS. But it's important to have someone to bounce ideas off of and to work through these numbers with, because you can't always see everything yourself. I tell people all the time that it's easier for me to write someone else's business plan and do someone else's financial projections than it is to do my own. When I sit down to do mine, I can't be sitting by myself and really get as far with them. But if I sit down with somebody else, when I sit down with somebody else, we tend to get a lot more done in the same amount of time, because there's a little bit of distance and support helps with that. So if you're planning on doing this, talk to Jeff, get some help, get it lined up. And that includes for Steve and those in the same ilk. If you just need to be done with all the farmers markets you've ever done and you need a new, you need to set up wholesale or something and want to price out what that's going to look at like and want to do those kinds of projections, talk to Jeff. He'll get you set up. We can see the goods for resale. We can see the cost of production. We can see the total overhead. You can see what that adds up with when you add in the new expenses. So that's the total operating expenses and the loan repayment, because we want to make sure for cash flow purposes that we're really taking that into account. If you're not planning to repay your loan, you're not going to have the money you need to repay your loan. And then the bank gets really angry and they come take your tractor back. So that leaves us with a net cash flow of $33,866. And one thing to think about with this, I think, is that there is not a huge difference in the net cash flow between last year and what we project for this year, which, if this is how you're paying yourself, is extra important. But this is also perhaps where money might be found to invest in your business again. So does this meet the needs that you have, the goals that you have for your business at this time? And this is one of the points where you're going to sit down and really think about that. And if you have multiple decision makers, now you're going to bring everybody in, because you can't make decisions for your business if you don't have all of your decision makers. Now we're going to switch back to the PowerPoint. So we can talk for a second about the sensitivity analysis. So we looked at the numbers all lined up. We decided that that made sense, or Sam and Rachel decided that for Waterville Farm, that made sense. There's a big investment. It's a lot of work. How do taxes come into play when you're dealing with net cash flow and owner's draw? Just to be clear, I am not a tax professional. I am a farmer. I am a farmer who likes to have help when filing my taxes. That's going to depend, I believe, depending on what kind of business you are. If you're an LLC or a DBA, things may be a little bit different. The important thing is that you have the numbers for decision making in a way that makes sense for decision making, and that you have help if you need it, which most of us do, in terms of getting things lined up for your taxes. If you're a DBA, it's a little bit easier, is my impression, but I don't know for certain, because I have always been a DBA, so I don't know. But if you need, there are a lot of people on the call today, and you may be able to find out from some of them, or through folks like Mary, who might be a good tax professional to work with for your farm. So going back to the scenario processing, the last step is a sensitivity analysis. So Sam and Rachel decided that based on the projections they made, the general projections they made, this is what we actually expect to happen projections they made, it made sense. They wanted to move forward. They wanted to do this, but they weren't entirely sure. Now they're pretty sure, and they need to do a gut check, and they also need to do a sensitivity analysis, which gives us the opportunity to say, this is what we expect to have happen. But what if it doesn't happen like that? What if next year sucks? What if the sales are lower? What if the sales are higher? What if the expenses are higher? What if we end up having to get to smaller loans and end up having a larger amount that we're paying over the course of each year? How do we see that information? How do we play with that information ahead of time so that we can feel comfortable with that and decide if this is really the best financial decision, and if we are able to feel comfortable and confident that we'll be able to pivot, make changes over the course of the year as we need to. So then we go back to Excel. And this is the same lineup that we saw on the last page. So the scenario plan is just one scenario. The sensitivity analysis is 3 scenarios. And because this is one of these green boxes, let us play with these things. We can change the numbers to see what's going on. This one is set up, so this is the information that's in the realistic scenario that we've been working with. The conservative scenario, which I think it's funny to call something conservative when it just isn't really doing what you want it to, especially these days. The conservative scenario is the point at which everything is going awry. The sales are lower than you expect them to. The production costs are higher than you expect them to. Maybe your insurance goes up because somebody hurt themselves, and so now you have to pay higher insurance premiums. Whatever it is, you can change things around so that you can say, what if a skunk gets in to the hen house? What if the meat birds don't sell very well? What if everybody starts going back to the restaurants and nobody's buying the meat birds anymore? What if the fruit production just doesn't produce as well as we expect it to? What if the flowers don't sell, or it's just terrible weather for most of our flowers and everything drowns, which might have happened this year? What if the vegetables don't sell as well as we want them to? What if we don't sell as much resale product as we expect, and we don't make as many margin dollars as the margin that we're seeing is smaller than we expect? So we paid 55% instead of paying 50%. So our margin on this would be 45% instead of 50%. If all of this stuff goes wrong, instead of $279,600, we would expect to see $258,000. What if we don't get to be as efficient as we pretended we were going to be able to be? What if our production supply costs go up, the feed costs go up? And so our operating expenses are higher. If those things happen, if both of those things happen, so lower revenue and higher expenses, we can still, in this, terrible year, as we are putting our heads into what a terrible year would look like in terms of our revenue and expenses, we would have $10,790 of net cash flow at the end of the year. So this is that point where you ask yourself, that first year might suck. How much is it going to suck, and how much can I handle it being terrible? This is a worst case scenario, right? We've played with all the numbers to make them terrible. The revenue is down, the expenses are up. Everybody hates this. It's not likely to happen. If that did happen, if you had this perfect storm of terrible, what would that look like in terms of your reality as a business owner? Aside from telling Sam and Rachel to look into SNAP benefits, because they'd probably qualify if this is their income, what would they have to prepare for? And that might mean this is a decision they decide, even if all the things are terrible, this is still the right call for them. They're comfortable with knowing that they'll be able to make those changes for their business and for their personal finances to make sure that everything lines up at the end of the year. Or they might stop, it might give them pause. They might stop and consider whether this is something that still feels like it makes sense to them. And it's worth stopping and having those conversations with your decision makers, because those are the people affected by your decisions, right? There's also an optimistic scenario, and these are really fun. In the same way that the conservative scenario is a downer, the optimistic scenario can be a lot of fun. What if everything goes right? What if you're super efficient? What if everything is awesome? Your sales are so high at the farm store that you need to buy in more meat birds and add a slaughter date. You need to buy in more pullets because you're selling the heck out of the eggs. You have a great year in fruit production. It's just going gangbusters, and the flowers are beautiful. They don't know what happened, but those dahlias are gigantic and everybody wants them. So you have all of these sales increases, right? So you have these high revenue, a lot higher than you anticipated it being, about 30 grand higher than you anticipated being. You also sell more in your resale category, which means that this expense is higher, but you made your margin. So your goal is to have a 50 margin in this. That is not necessarily the goal margin you will want if you are reselling. If you have questions about how to set those, talk to Jeff, get you somebody to talk through those kinds of things to make sure that everything lines up. But for the purposes of this example, they want a 50 margin, and they don't want to have much higher than that, because if they're buying in from other local businesses, if they were having a really high margin on those items, that would mean that they weren't paying their neighbors what they would have had agreed to. So we wouldn't want to do that. So we're saying they made their 50 margin. Their cost of production was lower than they anticipated as a percentage. It's about the same as a number, but it's much lower as a percentage because their revenue was higher. And that means that at the end of the year, their expenditures were less and their cash flow was more, and they made that 50, they reached their threshold $50,000 that they wanted. So the optimistic scenario is everything goes swimmingly. It doesn't always happen, but it's nice to pretend that it will. In my mind, the way that I think about these things is that the realistic scenario, the first scenario that you work through, and the one where the numbers are kind of in the middle, is going to be kind of the middle of a hurricane path cone. Blame the fact that my father is a meteorologist on that. This is how my brain works on this one. But when you look at these projections, you know that they get wider, right, as things go further out. So we've got, this is where I expect to be, and there's a line right in the middle. If you connect all of those H's and the S all the way at the end there, you have this line that you expect. That's what you expect your business to do. And it might go a little bit wonky. It might go a little bit off. You might not make quite as much money. It might go better than you anticipate. You might have a really good year. Generally, we're optimistic until the production starts, and then things get real. And so you have this range of reasonable expectations. I would argue that the conservative thing that projections we were looking at just a moment ago were maybe not realistic, but we have this range of what is probable. So your realistic ones are that line in the middle. And then you have this range of probable, and you want to say, all right, what's this range that I feel comfortable with? Because there's a point where it doesn't make financial sense. There's a point at which you're really just not going to be able to increase production past that point. What is that range going to look like? And that gives you a lot of comfort and a lot of control over how you make decisions within that range. Now that you have plans that take all of those ranges into account, as things change throughout the year, you can go back to those numbers and make adjustments and know that you can still, even if the feed costs go up, you can still make a percentage that makes sense for you. And if the revenue costs go up, that you can say, oh, right, we talked about this. Our expenses are going to go up dollar amount, and that's okay, but we can still have the dollar amount go up and the percentage go down. So you have that reference point to go back to. And then you can say, does it really still make sense? Is this still the right call for my business? And all of your decision makers get to make this decision together, right? Does this really still make sense for my business the most likely scenario is going to happen, if things go a little bit awry, or if everything is awesome. How does that change how decisions will be made? So how are folks feeling about that? Do you have any questions about how those differences work? The kind of low, medium, and high nets? A realistic scenario and percentages in terms of the percentage things would go up. So Haley. It's going to depend on where you are and what you've seen. So if you have a couple of years of information, you can see trends. It might be based on your particular location. Steve's saying up, down versus middle. So I would say when you're doing the projections as part of the earlier step in the scenario planning, you're going to end up getting a sense of what those, whether you're dealing with a number or dealing with a percentage, what each of those lines is going to make sense as. And it really does usually for most folks, I think, make sense line by line. So you ignore everything else and think about just eggs, ignore everything else and think about just meat birds. Same thing with your expenses. As you're doing those projections, you ignore everything else and think just about what your packaging costs are. And then those better scenario or worse scenario, you can add a few percentage points or remove a few percentage points just to see what that span would look like. I think Steve said it sounds like a better way bottom up. I think that way. I am hands in the soil producing most of the time. And so I think when I'm building these kinds of projections for my own business, I'm not thinking about it as a giant dollar number. Not that it's actually giant to begin with, but as one big dollar number and then breaking it down from there. But for folks who really think that way, that's how you would do it, right? There are two ways to do it. And I like that if you have more than one decision maker and they do think differently, you can do the projections in different ways and then sit down and have a conversation about how you landed on the numbers you've got and what the differences are in your perceptions or your framing that led you to those different numbers. So I think having multiple options for what works for you and what works for the other decision makers in your business allows you the most control and the most comfort that you're getting the right numbers for your business. Did that answer everybody's question? Everybody, Steve and Haley's question?
Ian, I'm going to jump in here with a perspective, which is these dynamic spreadsheets, depending on your planning process and how comfortable you are with the numbers, you can put a solid number in the income category and it will recalculate your percentage. Or if you are more comfortable in your planning process of saying, oh, I'm going to have a 5% increase, then you put the percentage in and it will automatically calculate your dollars. So you can work either way. It's not quite necessarily a bottom up or top down approach. It's more an approach of, have you gone through a planning process that gives you confidence in saying X amount of dollars, and that gets converted to a percentage which is used in planning evaluation, or vice versa? Have you gone through a process that gives you real confidence in the percentage?
Yeah, ultimately, I think that it's more about what makes sense for each person, how they think about their business. You know, being able to say the dollar amounts make sense, or the percentages make sense, because you can say, I think I can do a little bit more next year, or I think it's going to be a lot more next year that I can do in this category, can really help with that. Because, you know, we all approach things very differently. I worked with a value-added producer who was trying to figure out dollar production or dollar projections and couldn't do it. And I said, okay, well, let's do case projections. How many cases did you sell last year? Do you think you could sell more cases next year? And that made sense because someone who's thinks in production might not be thinking about dollars. She's not selling the product, she's making the product. She's got a business partner who's selling the product, right? So the business partner would probably think in dollars and then have to translate it back to cases. As long as everybody gets on the same page that ultimately you have both your production expectations and your number expectations, that's really important. How do you separate cost of production from cost of goods sold in your QuickBooks and profit and loss? You assign it in a particular category. So there is a way to designate the different types of expenses. And so if you designate the cost of goods sold separately, it'll break it out for you. I'd have to look at your QuickBooks to be able to specifically break it out for you. And it looks a little bit different on QuickBooks Online than it does in QuickBooks Desktop, but ultimately it's going into your chart of accounts and reassigning your cost of goods for resale so that it breaks out into a separate kind of master category. They cost of goods for resale. So Kate's asking if cost of goods for resale or cost of goods sold and cost of production both go above gross profit. And that depends on who you ask. Some people put cost of production above gross profit and some people put it below. Ultimately, it doesn't matter as much as long as you have all the categories there and you can think through it and that you understand where your money is going and why, and that you're consistent about putting the information in about your expenses. That's ultimately, it's more important to have the data than exactly what order it reads in. I come from a retail background, so separating out cost of goods sold or resale items completely from production costs makes the most sense for me. For a lot of folks, they have them both above gross profit. This is a little bit older of a way to look at it. That's one that I've seen more recently, but it doesn't really matter as long as you're really consistent about it. I believe the recording will be available through Mary. Thank you, Mary. I know that everybody had planned for this to go until about now. So anybody, I don't want to keep anybody, but I am hanging around for a little while if anybody has any questions.